Hello everyone, and welcome to this video on the corporate issuers topic area, specifically looking at corporate structures and ownership. So in this section, we're going to look at the different types of corporate structures which exist for people who want to go into business and have a look at the key attributes of each of them. So let's get started. Okay, so we're going to look at here really four main types of business structures. We're going to look at sole proprietorship. That's where one person is really in business for themselves. If they get a couple of friends or one or more friends to help them out, then they can go into general partnership. A relatively recent innovation in the business structure field has been a limited partnership, really been around since the late 1990s. Although corporations have been around a lot longer than that, really since the late 1700s. So we're going to look at the key attributes and pros and cons of each one. So let's look at sole proprietorship first of all. This is where the business is owned and operated by a single individual. And there's no legal distinction between that individual and the business. There's no separate legal entity. That individual has the sole claim to the business profits. So the business profits, the revenues minus the expenses, that represents the profits of that business. And those profits are taxed as personal income. So income tax is going to be payable on those profits. Now, one of the downsides of operating a business in this way is that the business owner is personally liable for any claims against the business. So if the business ends up incurring liabilities, if it goes bust owing millions of dollars, then unfortunately the business creditors can come after the individual themselves, and there's no insulation for them. So they are going to be solely liable for those claims against the business. General partnership is where two or more, you can't go into partnership yourself, so you've got two or more individuals, you could have many more than two if that's appropriate. They own and operate the business between them. Now, of course, as soon as you've got more than one individual involved, then there's the potential for disputes about how much of the profits each individual gets. So it's a good idea to lay that out in writing via a partnership agreement. Now, there's no requirement for that partnership agreement to say that the profits will be split 50-50. It often does say that. But really that's subject to agreement between the partners. So that agreement will state how much profit, what proportion of profit that each partner gets, as well as outlining the responsibilities that each of the individuals have for operating the business. Just as with a sole proprietorship, all partners are personally liable for claims against the business, and each partner is completely liable for claims against the business. So if the business goes into difficulty and creditors are owed an awful lot of money, the creditor can choose to sue one or all of the partners, and each partner is fully liable. As with the sole proprietorship state of affairs, the profits that are divided between the partners in line with the partnership agreement are taxed as personal income. So again, each partner will pay income tax on the profits that they accrue through this general partnership. Now, as we said in the introduction, a different type of partnership is a limited partnership. You'll sometimes see these referred to as LLPs, limited liability partnerships. Now, from the point of view of the limited partners in this partnership, they get a nice little benefit here. They're only liable for the amount that they've invested in the business initially. Okay, so if they invest $100,000 in the business and the business gets into difficulty and ends up owing millions, well, the limited partners will only lose what they've put in. Creditors have got no further claim against them. Now, in any limited partnership, there must be one partner, at least one partner, known as the general partners, who are personally liable for claims against the business. So you've got one unfortunate partner, at least one, who is not going to enjoy that limited liability. Instead, they are going to be personally liable for all claims outstanding against the business. Now, as you're going to see when we got onto the alternative investments readings, limited partnerships are very commonly the legal ownership in private equity funds and similar funds to those. The partnership agreement again states the claims to the profits. So the partnership agreement will say how much what percentage of profits each partner gets. And once again, the profits here are taxed as personal income. So there's no corporation tax or corporate income tax. Each partner pays income tax on the profits that they accrue from the partnership. And of course, here's our old friend, the corporation. Now, corporations have been around for hundreds of years, and a corporation has a legal entity entirely separate from the owners. The owners of a corporation are shareholders, sometimes called the members of the corporation. And this is quite unique in terms of business structure, in that the corporation does exist separately in law. In the case of limited partnerships, general partnerships, and sole proprietorships, there was no separate legal entity. So the shareholders, the owners, appoint the managers to operate the business. And those managers are usually known as the directors of the business. Now, with corporations that reach a reasonably large size, it would clearly be just unrealistic for all of the owners to make all of the decisions themselves. They'd have to end up meeting in a football stadium to make decisions. So they delegate their power to the managers, to the directors, who make the decisions to operate the business on their behalf. Just as with limited partners in a limited partnership, the shareholders, the owners, are only liable for the amount that they invest. So the owners will have put some funds into the business when they bought their shares, and if the business gets into difficulty and collapses, the shareholders are not liable for any further debts. Now, with a corporation, because it has a legal entity separate from its owners, the profits may well be taxed at a corporate level. So you're going to have some form of corporate income tax to pay. One of the downsides of having legal personality is that you have to pay some tax. So the profits are often taxed at the corporate level before the remaining profits, the residual profits, which are distributed to the shareholders in the form of dividends. Well, you might get this problem of double taxation, because when the shareholders receive the dividends, they're going to pay income tax on those as personal income. So you end up with double taxation. The profits are taxed twice. They're taxed once at the corporate level with the corporate income tax, and then they're taxed again when the dividends are distributed to the shareholders. Now, corporations exist in various forms, and one distinction we're going to look at right now is the for-profit or not-for-profit corporation. Now, usually when we think about corporations, we think about for-profit corporations. Most businesses are constructed along those lines. But a not-for-profit corporation is set up not to pursue profitable goals, as the name suggests. Instead, it's established to pursue some sort of social good or charitable goal. Now, as a result of that, they are often tax-free. Okay, so not-for-profit corporations will often enjoy tax benefits, but in order to maintain and to keep these tax benefits, they've got to reinvest any profits they generate towards their stated aims, their stated missions. The minute they started distributing profits to shareholders, then they would be at risk of losing that not-for-profit and tax-free status. Another way of distinguishing between the population of corporations is private and public. So a public corporation, actually the legal definition of that depends on where you are in the world. Each jurisdiction has got a slightly different definition, but usually they have two attributes in common: that the shares are traded on an organised exchange. They are listed companies. Public corporations are listed, so members of the public can buy or sell those shares on the stock market. And they've got a minimum number of owners, number of shareholders. That can be two or more. It's usually at least two, whereas a private corporation is permitted to have just one shareholder. And in fact, a private corporation, really, for our purposes, for CFA Level 1, is any corporation that doesn't meet the definition of a public corporation above. So if we say that the corporation does have shares trading on an organised exchange and it's got a minimum number of owners, then it would meet the definition of a public corporation. Now, why is this distinction between private and public important? Well, only public corporations are permitted, legally permitted, to sell their shares to the public. Now, a private corporation can become public through various methods. So one of the most famous methods here is the IPO, the initial public offering. That's where a corporation which is currently private arranges to list its shares on the stock market for the first time. So it offers its shares to the public for the first time. That's an IPO. A private corporation can become public simply by virtue of being acquired and being absorbed into another larger public corporation. A private corporation can, by agreement with the local stock exchange, simply list its existing shares on the stock market. Okay, now, no new shares are issued at this point. Simply the current existing shares, which are held by the private shareholders, are now listed in the stock exchange, and those shareholders are now free to sell them to the public. With an initial public offering, there is a new issue of shares directly to the public. And a specific and rather niche method that a private corporation can become public is through a SPAC, a special purpose acquisition company. So this company is set up for the purpose of acquiring a private company. The SPAC, the special purpose acquisition company, raises capital itself via an IPO. Okay, so it itself is a public company. It raises capital via an initial public offering. It places those funds in a trust. So it places the funds in trust to make an acquisition of a private company. And there's usually a time limit on the length of time that those funds can sit in trust before time is up. Now, these companies are sometimes known as blank check companies, because at the time that the SPAC raises capital via an IPO, it's not necessarily specified which private company it's going to acquire. Instead, that's left for people to wonder about. So we don't quite know which private company the SPAC is going to acquire. We just know that it is going to acquire one of them. So just as private corporations can go public, so can public corporations go private and essentially delist from the stock exchange. The two principal methods here are leveraged buyouts, where outside investors purchase the shares from the public exchanges and take the company private. A management buyout is where the existing management of the firm, usually via quite a lot of debt finance, arranges to purchase the shares and take the company private itself. So leveraged buyout would be by outside investors, whereas a management buyout would be the existing management of the corporation. Now, as I said a little while ago, private corporations can raise funds, but only through private placement of shares. They can only offer them to accredited investors, such as institutional investors and specific high net worth individuals. They are not able to sell shares to the public. Okay, so if we think about the providers of finance to corporations, we can split them up into debt holders, often we'll call these guys bond holders, lenders, and equity holders, which would be the shareholders. Okay, now debt holders, those who have lent money to the company, well, they've got a legal claim to be repaid. Okay, so that's the principal and interest that a corporation owes them. So if an investor buys a bond, well, they're entitled legally to the coupon, the interest on that bond, and then the face value of the bond when it comes to repayment. So really the best it gets for debt holders is that those repayments of principal and interest happen as planned. Okay, so the debt is fully repaid. If the company makes an outstanding level of profit, well, they don't really benefit from that. Okay, the best it really gets for them is that their bond is repaid and their interest is repaid. In the event of a liquidation, if the company is wound up, then the debt holders are paid before equity holders. So debt holders really are subject to a less risky investment. Okay, so it's a less risky investment. They get their bond repaid in full, and they get repaid in the event of a liquidation before the shareholders do. Now the shareholders, the equity owners, the owners of the company, they have as a residual claim after all other claims have been paid. So in the event of a company being wound up and its assets liquidated, Well, once all the creditors and the lenders have been paid, anything left over belongs to the shareholders. Now, in an insolvent liquidation, where a company goes into liquidation because it's struggling, then there's often nothing left over. So these guys only get paid after all other claims have been paid. However, theoretically, an unlimited upside, okay, because you've got an theoretically unlimited profit potential. Okay, so the company makes profits, and ultimately it will repay those profits, or it will pay those profits to the equity shareholders in the form of a dividend. So if the company does spectacularly well, then the shareholders will benefit from that upside, unlike the debt holders. However, when things go wrong, the shareholders get paid dead last. So overall, we would say that shareholders have a more risky investment than debt holders. Now, because of their conflicting claims, we would say that the interests of both debt holders and equity holders can conflict. They're going to want the company to do different things. From the debt holders' point of view, they may well want the company to take less risk. Because remember, all they want is to have their interest and principal paid on time. They don't really benefit if risky decisions pay off and increase the company's profits. So if the company were to take actions which were to increase the growth rate and the risk level of the profits, perhaps by raising additional debt to increase leverage, well, shareholders, equity holders, are likely to be very happy with that, okay, because the chances of them making more profits has gone up. But the debt holders probably going to be unhappy with that one because the company's risk has increased. So the risk of their debt being repaid, not being repaid, has increased, and there's no real upside for them. So you'll often find that, well, not just equity and debt holders, but company stakeholders in general will have conflicting objectives which need to be balanced by the directors.